So yeah, this is Michelle actually brought iBuyers up to me. I mean, this is maybe 2-3 years ago when she said, agents were getting more worried that, Zillow, or not Zillow actually wasn't even a thing at the time, but Open Door, OfferPad, Knock Homes was a bigger player in this back then as well. And what wound up happening is we started garnering more interest towards it. And good news for y'all, all the agents at Solid Source. Michelle, I'm actually going to be sending Solid Source this presentation updated every quarter moving forward. This right here is going to be from first quarter. So we do come out with it for tracking deeds. These aren't instantaneous data records that you might be familiar with, like an MLS. Something closes, agent will put it in that week. We have to wait typically 3 weeks to get a warranty deed. So when second quarter is finished, this is second quarter. When third quarter is finished, which is going to be the end of this month, we still are going to wait another month to get all the data to still come in for September, especially. And then at that time, we'll send this out as well. So iBuyers, a lot of that video kind of explain what they do and what their, goal is in business to make money out of this. And so I think these graphics will really help, explain, understand what has been going on with the iBuyer market lately. And so we have here, as you see, Knock Homes, OfferPad, Open Door, and this is the exact pool from the report that has been sent out. And you'll see, I mentioned that in the video, but let's look at the graph. I think it's a lot easier to explain things with visuals, such a graph, compared to text or just, speaking out loud about it. So you can see back, it's actually started in mid-2016 when Knock Homes came in. You can see they weren't doing that much, though. I mean, every month they maybe did anywhere from 5 to 20 purchases that month. And then we had Open Door enter the market in mid-17, followed by OfferPad. And then finally, Zillow had their first purchase back in the late 2018. And so it actually was picking up. It kind of peaked at one point in the summer of 2019. And I think that was the peak worries that agents had about iBuyers coming in and, taking potential clients away from them. And it's a little interesting. I mean, we've been doing these reports for nearly 2 years now, but what was going on here, and why you saw a little bit of a slowdown, even before COVID, we saw it diminishing a little bit. Zillow was actually offering too much money a lot of times for these homes. And so I think they maybe changed their algorithm of some sort, restructured their purchasing plan, because they were slowing down the purchases even before COVID hit. And then once COVID hit, you'll see that there was essentially no purchasing happening. And I said this in the video, they were down, 95%. And that was a stat that I couldn't believe. I was like, is something wrong with their data? Started Googling other articles, people who might be tracking this, and they're saying the same thing. For me in California, iBuyer purchases, or Zillow specifically, were down 97% from second quarter of 2019. And so, everybody was scared about the market when COVID hit. And I'm going to show some industry slides upcoming here pretty soon. You can see once COVID kind of, was taken care of, but the real estate market really started picking back up in June overall. And you can see what happened. We have had a huge spike, especially in the second quarter. A lot of people probably seeing their Zestimate go up on their house. They're like, oh my God, it's down 10% in, the last year and a half, based off this offer they're giving me. But in reality, the market's actually heated up much faster than that 10% they might be, seeing on that quote by Zillow or OfferPad or Open Door. And then on the right-hand side, you'll see actually the market share. And so these presentations, there's going to be a few more slides coming up. Going to be kind of structured the same. We'll change some of the little quotes in here. But relatively, you're going to see kind of the same structure moving forward. You can see Open Door is the largest iBuyer in the metro Atlanta market. When they first came in 2017, they're only about half of all the purchases. They've gotten up to over 2/3 now, 70%. You can see Zillow is the second biggest chunk, followed by OfferPad. Knock Homes essentially pulled out of the market at the end of 19, very beginning of 2020. So they're really not even a player in this iBuyer purchasing in Atlanta anymore. We still include them in the slides just to let you know, this is what they used to be doing. For being the top iBuyer in Atlanta just 4 years ago, they've been effectively pushed out of the market by some of these top competitors, Open Door and Zillow. But you look at this, Zillow makes up maybe almost a quarter of the market, while Open Door makes up 70%, and I believe OfferPad was just over maybe 7-8% of the market share. And looking at our breakdown, this is the last 12 months for purchases. And hopefully this bar isn't covering up. It is on my screen. Hopefully this isn't covering up the slide titles. But OfferPad, Opendoor, Zillow, like I said, almost 2,200 purchases the last 12 months. And we mentioned this in the video, $22,600. That is the average difference in price that one of these iBuyers buying this person's home, and then they're selling it on average 69 days later for $22,600 more. We'll see a couple over 100,000 every now and then. They're pretty wild. And then fill days on market, 21 days. You know, they're going on the MLSs for not that long. They're maybe some people are kind of freaked out, like, why is this $22,000 higher than what they paid for it, if they can even see that information. But a lot of these homes are lower priced as well. You'll see the average price in Metro Atlanta for an existing home is actually over $400,000 this summer. But the average price that they're paying is not that expensive. You'll see that stat here in a second. Looking at the county breakdown, when Michelle and I first talked about this, we figured, it must be happening in a lot more rural counties. But it's actually quite the opposite. Most of the purchasing is happening in your core market, Gwinnett, Cobb, Fulton, DeKalb. I mean, those four alone make up 56% of all iBuyer purchases. It makes sense. That's where most homes are located, most opportunities to even buy a home. But these top 10 counties, that's where you're going to see most of the activity for iBuyers. That's 86% of all iBuyer purchases in Metro Atlanta. And then just another little graphic to show on here. You can see the purchases, a little bit more visualization. You can see how much Gwinnett is doing compared to some of these other counties and their average price differences. I mean, Forsyth alone is nearly $30,000 difference. But the majority of the counties you'll see is going to be right around that $22,000 number. A couple more kind of macro stats, and then I have a couple pretty good examples to show you. One for the north side of Metro Atlanta and one for the south side. This is actually a regression graphic. It's showing you the square footage on the bottom, the sales prices on the left-hand side. So these homes typically are selling, let's say a home for 2,500 square foot, that iBuyer on average is going to pay about $283,000 for it. But on average, they're going to sell for just under $320,000. So overall, we've kind of already talked about these numbers, but $10,000 or more from purchase to sale, that's almost 80% of every single iBuyer purchase. Their average price is only $239,000. The average sales price for a resale home, Metro Atlanta, is $350,000, $370,000 last 12 months. I just mentioned it's $400,000 over the summer. So they are buying, on average, the less expensive homes, but they're going to sell them for $261,000. Average price difference $22,600. Price increase of 10%, 69 days between sales, 21 days on market. And so let me hop into a couple of these examples. A little bit easier to comprehend when you start seeing the examples. I think this is really something that you would show a potential client of why they should maybe go with the iBuyer. So onto the iBuyer. So this is an actual example. This is in Beaufort, Georgia. Opendoor bought this home back in March 29th, 2021. So less than 6 months ago for $279,000. They then sell this home for $355,000 in May. It's a price difference of $75,700, 57 days between sales. It was only on FMLS for 10 days. So this seller obviously left a lot of money on the table. Here's kind of a good breakdown. I chose 8%. You could easily bump this up. This is probably the most conservative number you can go with right here. But just let it be known, some of these people get 9, 10, 12%. So this number would be even higher. If we bump this up to 12%, that's going to be $33,000 in service fees, not $22,000 and change. Seller concessions, 0. That's one of their advertisements on there. Repairs requested by iBuyer, that's to be determined. The same thing for selling with a typical agent. Although a lot of homes today are being sold with no appraisal contingency, being bought as is. They're getting all cash offers. It's really the hottest market we've probably ever seen in our lifetime in Metro Atlanta. But net cash to seller $257,000, and then you break it down using a traditional agent. So this is just an Opendoor agent that knew the home was actually worth $355,000. Maybe they had it listed for $340,000 and it was a bidding war for $355,000. But here's your 6% commission, really seller concession of 1%. There's not really much seller concessions anymore for the most part. That's kind of been going away since you're getting all these bidding wars. But overall, you're seeing this big breakdown. $257,000 is what this person actually got. they could have gotten at least 330 grand easily. And it really would have only taken an extra 2 weeks of, using an agent and selling it and having to work with them to get the house ready. Here's another example on the south side in Ellenwood. Same thing, Open Door. 70% of all purchases are through them. So a lot of the examples are typically, we'll see Open Door buying these homes. But 197 was bought on April 1st. It was sold literally almost a month later, May 5th, for $261,000. The price difference of $64,200. 34 days between sales, FMLS for 11 days. So just another great example. Same thing with the breakdown. You can see how this buyer, and if this person's selling a home for $197,000, let's say they are, their next purchase is maybe $250,000, they're leaving $70,000 or just over $60,000 on the table. That home for $250,000, that's your down payment essentially that they're leaving on there. But that was the end of the slides. Like I said, I'm going to be updating this moving forward every quarter. I actually present this almost on a weekly basis at this point. People are really interested in what's going on because it's been a roller coaster ride the last 18 months. From before COVID, we were kind of picking the market back up again. Rates are going back down, which is great. COVID hits, everybody freaks out for 2 months. We were one of them. We had no idea what was going to happen. And then somehow in June of last year, it starts picking back up again. And then July was even better. And then it started taking off. And it took off for almost the next 12 months. We're seeing a little bit of a slowdown the last couple of months, which is kind of what we predicted. I think last fall, Michelle, I stopped by and we talked about, we can't see prices go up 30% forever. That's slowing down a little bit. We thought actually resale closings are a little bit down the last 2 months as well compared to July and August of last year. But I'm going to show this a lot visually through graphics. I'm going to start with new construction. So, our company is primarily new construction. Our primary clients are going to be new home builders or really anybody focused in the new construction industry. We do cover the resale market extensively as well because the resale market makes up the majority of the closings. And builders, they don't always say, hey, our rival builders down the road, what are they doing? They also want to know what's going on in the existing home market because their buyers are not always just looking at new construction. They're looking at the existing home as well. And in reality, that's probably their biggest competitor is actually the existing home market. So I have a couple slides on new construction. I'm going to focus more on existing homes, the relationship between the two. We're going to talk about inventory and months of supply. That's a big topic right now. Pretty much all these slides are actually pretty amazing when you really truly think about them. And then also I want to talk about mortgage rates. That's a big topic that has been ongoing for the last couple of years. Actually, really the last 4 years. It's really impacted the market quite a bit. So if you see the new construction market, you can see how we had very steady growth. We bottomed out in 2011. Pretty much almost every housing market bottomed out in 2011. Best time ever to buy a home in terms of price, discounted price, is definitely fourth quarter 11, first quarter 12. And then we saw in 2013, that's when the market really started picking up. We had this nice steady growth. You see 2019, down 2%. That's actually a pretty common trend. If you remember at the end of 19, mortgage rates were touching nearly 5%. That scared a lot of buyers out of the market because their purchasing power was greatly diminished because of those mortgage rates going up. The rates started going back down in 2020. Rates were going up. Yeah, I misspoke. At the very end of 2018, and then in 2019, they started going back down. So 2020 happened. We actually were up. But look at the grand scheme of things. We're thinking we're going to hit maybe 30,000 new home closings this year. That's still about half of what we were doing back in 2005. So a lot of people who are a little bit more fresh in the market and don't have data that goes back this far are saying, this is the hottest new construction market's ever been. In reality, it's still nowhere close to what we were doing. Granted, this is a bubble. Atlanta was the hottest market in the entire nation at the time. Last year, I believe we were third in new home closings, new home construction, behind Dallas and Houston. We were fourth in permits behind those same two cities, and then also Phoenix. So we're still one of the top markets for new home construction in the entire United States. But you can see, just like those other markets, Dallas and Houston not quite as extensive of a drop. So you can see we're still not even building as many homes as we were in the late 90s. We're building as many homes today as we did in maybe 95, which was 25, 26 years ago. So, and also new construction was the last slide on it, but same kind of breakdown. You can see the big peak, big drop, and then where we are today. This is year to date. But I want to show the market share. And so you might be noticing in this in some of your markets or some of the places where you live. There are a lot of townhomes that have been getting constructed. We started tracking data back in the late 90s. Second quarter, nearly 25% of all new home closings were actually a townhome. That's the highest we've ever seen. Not highest attached. We used to do a lot more condos. Condos have really been just depleted segment in the new construction market for nearly 10 years now. And even actually back in 11 and 12, this was just them selling off all the units, most of the banks for, for 50 cents on the dollar. So hopping into existing homes, I think it's a little bit more relatable. I want to show new construction just because it is still an interesting topic as well. But resale prices in 2020, we actually had our housing summit in March of last year. It's a pretty rough time, obviously. I think it was on the second or third week, CALLOUTS was a sponsor of it. And we had a lot of people the night before, the morning of, say, hey, we can't go. Our company's making us, all company travel is shut down. We can't show up. And so, I think the NBA got canceled that night. But we had really high outlook for the housing market, even before COVID was ever in discussion among us. So you see January and April up 6%, and we saw a little bit of a slowdown. May prices were down slight, June up a little bit. And then I said, July it just started picking up, and it never slowed down. So these are a little bit archaic numbers. I'm going to show you year to date here in a second. And then closings, huge drop off in the spring, all COVID related. Nobody's looking in their home. I don't think anybody wanted to buy a home at the point, because at a time you didn't know if the market was just going to crash everywhere around you. The housing market, the stock market was crashing. Third quarter up 14%. So we were up 15% in prices, 14% in closings. And it was actually very exciting. Every month we would get numbers in and we're like, all right, what was it up this month? And fourth quarter, the closings up 20%, prices up 17%. And it's we're like, all right, it's going to slow down eventually. It can't go forever. We knew that first, second quarter was going to be great, especially second quarter. So we had such a bad second quarter last year. But through August 2021, retail closings are up still 14%. That's still an amazing number. Q2 is skewing it a little bit. We had a huge drop in Q2 last year closings. So that is why you'll see, I mentioned this on the first slide, we have seen a little bit of a slowdown. I think a lot of it is being price driven. There's just no inventory on the market that is picking up a little bit, but we're still down inventory. And then, so prices, they're not slowing down. We have been pricing a lot of people out of the market. And I think that's why you're going to see these closings come down. I think you're going to see prices really start to flatline, get more to that normal range of maybe 3 to 5% year over year. And I like to look at everything visually. So we have this very historical. We're going to zoom in on this in a second. So it's kind of hard to see, but these are all gold bars for the number of resale closings in Metro Atlanta by month, dating back to 1999. And then we have a T12 total. That's really the number you want to be looking at. You can see this huge bubble forming right here, huge crash. Start picking back up, and then I'm going to zoom in on this just to show you. This has been a kind of a chaotic looking graph right now. You see a little bit of a flat line in the last couple months, but when we had mortgage rates touching nearly 5% at the end of 18, that really caused the market to slow down. You can see we had about a 2-3 year period of really just flatlining on resale closings. Right before COVID hit, though, it see this little pop up, and we thought we're going in the right direction again. COVID caused a slowdown, and then you see in June picked it right back up. So now we're doing over 100,000 resale closings in the Metro Atlanta market. Never been anything close to that before. We're kind of at this 88,000 number for quite some time. In comparison, we were doing 80,000 closings back in the peak days of 05, 06. Looking at price-wise, and I actually added this in because I think we actually mentioned it in the video last week, and I thought it'd be kind of neat to bring it back. You can see, same thing with the gold bar, the average resale price by month, 1999. The dark blue line is a year-over-year change, and so anytime the blue line is below 0%, that means resale prices are crashing 10, 20, 30%. Here's your housing stimulus. It helped a little bit, came right back down. And then we start picking back up in 2013. That was the first year of dramatic improvement. I'm going to zoom out on this in a second, but I want to explain this green line. This is since 1998. Let's assume that 4% growth in price was the norm, which it kind of is the norm in the industry. And we were doing that from 98 to 07. You can see how much we crashed. And in reality, it's taken us 14 years to finally get back to that 4% range. And I think, little did we know that COVID was going to be the reason that we would have this spike. I don't think anybody ever predicted that when COVID first came to the United States, but we realized how severe it was going to be. But we're actually right at that 4% mark. I think if you're going to see prices continue to rise past that green line, you will see, I don't know if there's any significant slowdown. I think still the desire to own a home is the highest it's really been in 15 years. So people still want to buy homes, especially with the millennials coming out. There's still a huge wave of millennials that are looking to buy homes right now in their early 30s, want to have kids. But going back to the zoom in on the price of year-over-year change, you see 5%, 4%, that was kind of the norm. And we saw a little bit of a slowdown due to mortgage rates, came right back up, and then COVID happened. We saw our first drop in a very long time. It was the first year-over-year drop for pricing since 2011. So we came right back in, and we're starting to slow down already. This is kind of a good number, in my opinion. I'm sorry. You don't want to see the prices go up 25. I mean, it's great if you own a home. It's great if you're looking to sell a home, but you're going to be running out of buyers if you keep doing that. I think we're going to be coming into a more normal market here in the near future. And this crazy run has really helped a lot with people building their equity in their home. But it's gonna have to slow down. So here's a month of supplies. A lot of these slides are going to be based on mortgage rates. Now they're kind of based on COVID. They really had the two biggest impacts in the real estate industry in the last 5 years. So what we saw here is this is monthly inventory. So the number of homes listed for sale at the start of the month. The green dots are going to be a year-over-year change. So we were pretty consistently losing inventory from 16, 17, mid-18. What happened right here? We saw mortgage rates starting to rise. We saw the number of listings start to rise. So there was not as many buyers. Rates start coming back down. And then here we are in February of 2020. We actually finally went below 0% for the first time in over a year. And so we thought, all right, what happened with COVID? And so we saw a little bit of a pickup. More inventory actually hit the market. And then what happens next, I don't think anybody really saw coming. We saw dramatic drops in inventory year over year. We went from 24,000 homes for sale, and then just over a year later, we have 8,000 homes for sale on MLS. Showing 60% drops in listings. It's really something we've never seen before. It has changed a little bit. I'm stopping this in May of this year, so fast forward in the next 4 months. You see, we're still dropping pretty significantly, but we are adding more inventory to the market. I personally think that's a good thing. You're going to see the supply rise a little bit, but it's going to control the pricing. You're not going to see prices jump 25%, and you see inventory starting to rise as well. It's really more of a way of protecting the future of the market. I don't think we want to see a 12-month dramatic drop in the real estate market. So, month of supply. What's happening here? We have record high closing numbers. We have record low inventory numbers. 8,000. Think about it this way: we have 8,000 homes for sale, but we're selling 100,000 a year. That's going to drop your supply dramatically. I'm going to show you just the history first, and we'll jump into the zoomed-in version of what's gone on in the last 5 years. So the 20-year average is 6.5 months. A lot of people in the industry still consider 6 to 7 months as equilibrium. The more people I talk to, it's like, 4 months really should have been equilibrium. Maybe that is the case. That was kind of what we were before the bubble really started forming in the early 2000s. I heard builders say 2 months, whatever you think it is. I think 4 is a pretty good number. I think if we were to hit 6%, we would have a little bit of crisis in the housing market. But you can see, the data you don't speak of anymore, but back in 8, 9, 10, 11, we saw housing inventory over a year at some months. And then fast forward to today, saw it dramatically dropping, mortgage rates starting to rise, more supply rise because we have more homes for sale. And then COVID hits, and then everybody starts buying a home. and there's nothing left for the market. So we actually saw a number that I don't think we ever can imagine seeing. It's under 1 month of supply. We're still at about 1.1 up to 1.2 with today's numbers, but still compared to any other metric in the history of Metro Atlanta, we are nowhere near. If we do have some sort of slowdown, it's not going to be like it was back then. If you look at the housing market before the dot-com bubble, we really just kind of blew right through it. We had a little bit of a slowdown, but with no collapse. And I think a lot of the millennials, our friends I've talked to, I remember the last 5 years, I bought a home 6 years ago, and they kept saying, I'm going to wait for the next housing collapse to happen, just like it did 10 years ago. And I kept telling them it's not going to happen. If we have to slow down, it will be pretty minor. And our only minor slowdown was literally the shortest lived housing recession probably ever. And that was due to COVID, the March, April months. Looking at it, this data was just pulled. This is looking at a single point in time. You see our 1 month of supply. But now we're looking at my price ranges. And this is pretty tremendous. Every single price range is considered undersupplied if you're looking at 6 months. If you're looking at 4 months, pretty much anything under $1 million is undersupplied. If I ran it 3 years ago, you would see the $1 million market at 18, 20 months supply, just to give you perspective of how different it is today. But even the price ranges, the average price of a home is high threes right now. That's under 1 month of supply, the average price. So we're still very undersupplied, even though we're seeing the number of listings go up a little bit. 90% of listings are under 3 months right now, and the only price points that are technically oversupplied, if you look at the 6 or 7 months or higher, that's going to be 1.9 million. I'm going to compare existing homes versus new construction. I know I talked briefly on new construction, and Michelle actually needed to send you an updated version of the slide. I did this about 10 minutes right before I jumped on. But we're actually going to take the new construction closings, add the resales, and then you stack them up, you actually get your total number of closings. But disregard the blue line for now. Let's talk about that in a second. You can see we're doing about almost 140,000 closings projected for this year. We did just under 120 last year, so maybe we'll do 125 or so. We still have less closings on the market compared to 05 and 06. Look at the population though. The population back then, we had 4 million people in Metro Atlanta. Now today, 6 million. So we've actually gone up 50% population. That's another reason why this Atlanta housing market, there's so many metrics, there's so much room to succeed moving forward. We really don't think it's going to slow down. There's almost no way to slow down the next 2 years. We feel pretty confident about that. I've talked to a lot of other economists and other industry experts, even top home builders. They feel pretty similar as us. They're still out there buying lots. They feel very confident. This market really won't have any sort of slowdown. So I'm going to read from this to you, Michelle, and then also comparing the two, new construction closings versus resale. This is kind of like a little history lesson on Metro Atlanta. So Metro Atlanta was booming back in, before the bubble burst. What's pretty interesting is back then almost half of the market, the exact 45%. The 45% of the market was new construction. When we crashed, only 10%. But even today, we're kind of just stuck in this 20 to 25% ratio. And I don't think we'll ever really bust out of it. I mean, we're going to be a consistent home market really moving forward. We had our time as a new construction market, but there are just so many homes, inventory-wise, that are existing. They're not going to be new. And there's so many other factors. I'm not going to get into that. I talk in my home builder meetings. We'll talk about what issues home builders face. I'd be happy to answer a question if somebody wanted to know more, but there's still a lot of issues home builders are facing that you're not going to see in the existing home market. And looking at prices, I think this is a little bit more tremendous. This is actually a great stat. A lot of home builders will love to see this. And what this is saying is just taking the resale price, which is green, and dividing it by the gold bar, which is the new home price. And it's giving this ratio. So what it's saying right here is that resales before the bubble burst are about 90% of the cost of a new home closing. Why did the resale market crash in the previous slide? Well, that was because resale prices were nearly half of the average new home price. Builders you can't build anything and sell it to keep the resale market because the resale market was so depleted. your prices going down 30%. It was pretty much impossible to build a new home unless you were in one of the most desirable markets, like East Cobb, North Fulton kind of area. You can see it has been driving back up pretty consistently. We hit this 80% number in 1819. Like, all right, we're back to kind of a norm. Look at what's happened this year, though. The average resale price is actually higher than average new home price in Metro Atlanta. This is very odd. You never really see this happen in any market we cover, except for the coastal markets like a Savannah, a Charleston. I don't think Myrtle Beach is even this high, but it's actually almost every market we cover. This is happening. Almost every market, resale prices are getting more expensive than new construction. There's a lot of factors going into that, but it's still kind of one of those eye-popping things to view on here. And then lastly, mortgage rates. I feel like I'm probably going a little bit over time because I know you might have some questions, but this is something that I'm sure everyone here keeps track of pretty consistently. The 30-year mortgage rate. I alluded to this 5% back at the end of 18, a couple slides, and then that was really a big reason why the second half of 18, first half of 19 were slow, and we saw down numbers really for existing homes and new construction. We started coming back down, and then COVID hit right here, and we just keep going, get under 3%, 2.7 or 2.75, and then we saw it going back up, and then it's just kind of stuck at the 2.8% range. Showing you historically, we're going to hit 3.5% probably again in the next couple of years. And people are going to be freaking out thinking that, oh my God, rates are so high. Look at it historically, and the average for the last 8 years is 3.8. Looking at it from since 1971, though, the last 50 years, the average mortgage rate has been 7.87%. I'm sure that if anybody bought a home in the 80s, like my parents, they like to remind me all the time of that I have it so lucky. They had to pay 12, 14% for mortgage rate. But when you look at the last 10 years, you can see just how big of a difference it is historically. Even if you look at maybe 05, 06, rates back then were 6%. So we're less than half of the mortgage rates that we were experiencing before we had the Great Recession. And then this is a slide. I've shown this to a lot of the marketing teams of home builders, and they're always like, "Oh my God, we gotta blow this up and put it in our sales office to get people to buy more homes." And what this is showing you is this dark blue line is that same 30-year mortgage rate. So here's your dark blue, end of 18, nearly 5%, right? I'm crashing down. What this is obviously a direct mirror of it. It's completely flipped over, and it's kind of an affordability calculator. I've shown this before in the past at a couple of CALLOUTS presentations, so I can keep updating it. And what I did here is back in end of 18, the average price of a home, existing home, is about $285,000. If you ran the numbers, if I bought a home for $285,000, I could put 20% down, but I can only afford $1,200 a month. This is how much home I could buy. It was $285,000 because of rates being there 4.9%. As rates have gone down, the same buyer who can only afford $1,200 a month can now buy a home worth $360,000, $370,000. And they're still paying only $1,200 a month. There's actually a lot of assumptions made. There's no insurance taxes or HOA, but it is showing you kind of how much influence mortgage rates do have on the ability to people to buy more expensive homes. So if we do see rates start to rise tremendously, see a lot more inventory on the ground, you are going to see home prices either flatline. They actually might be down a few percent. I don't think we're seeing any sort of crash, but definitely two metrics to keep track of. I don't want to, I own my own home. I'd love to see my home keep appreciating 20% year over year. But the problem is I'm eventually not going to be able to find a buyer for that home. So that was the entire presentation. Hope I didn't go too long, but Michelle or Derek.
Mitchell, oh my gosh, that's such incredible information.